This is your LMAX exchange technical update for Tuesday, November 14th, 2017. Euro dollar. So the euro is trying to break back up. 1690 is the key level that we want to pay attention to, and we want to see if the market establishes a close above that level on Tuesday. A close above 1690 would take the immediate pressure off the downside and suggest that the market could be looking to start to push back up for a resumption of this uptrend in 2017. At the same time, we still can't forget about this head and shoulders top that is triggered on the daily chart, which does still leave the door open for deeper setbacks for a pattern objective all the way down at 112.30. And so 1690 is key to watch on Tuesday to see if the market closes above or closes below. If the market closes above, then we could be headed higher. Of course, we believe that a break back above the right shoulder of this head and shoulders top at 118.80 would ultimately be required to suggest and to strengthen the case for a bullish resumption. Support right now on the downside is key at that low from the previous week around 115.54, 115.55. Sterling dollar. So cable continues to chop around. The market has not really gone anywhere over the past several days. The market confined to a range between 130.25 and to the top side we're looking at resistance around the 133.40 area, and a close on Tuesday above or below would be required to suggest that the market is looking to break out and to offer some clearer directional insight. If the market breaks down, we've been saying that we do believe setbacks should be limited in light of a weekly chart that is showing potential for a longer term bottom in 2017 as the market breaks out above that previous range resistance off the multi-year low, that plus 30-year low that was seen in late 2016 down in the 118s. The break above 127.75 was what did that, and so setbacks are expected to be limited if we do break below 130.25. On the other hand, if the market pushes back up above the 133.40 area range high, this would set the stage for a continuation of this move in 2017 for a retest of the 2017 high all the way up at 36.60 about, and then exposing 140 further up. Dollar yen. So dollar yen continues to show signs of the possibility of stalling out up here after testing this multi-week range top. Really for the most of 2017, the market has been trading in a range roughly defined between 114 and 108, and so the market could be stalling out here. We believe that if the market breaks down and establishes a break back below 1165, that's 111.65 over here, this is a low going back to the 16th of October, it could do a good job of accelerating those setbacks back towards the 2017 low. Euro Swiss. Euro Swiss has been grinding higher, and the market is clearly now focused on the top side, but there is risk for short-term setbacks. We do believe setbacks should be limited to the 114 area, and ultimately only back below 112 would compromise what is now a constructive outlook that eventually favors a push back towards that 120 psychological barrier that was last seen in January of 2015. Aussie dollar. So Aussie has been trading with a bearish tone of late. The market has been consolidating. Recent price action has been consolidating roughly in the 76s, but we could be looking for that next major downside extension and continuation of declines into the 75 area. Any rallies here should be well capped, with only a break ultimately back above the 79 handle to compromise what is a bearish outlook for Aussie dollar right now. Dollar CAD. So we had talked about dollar CAD setbacks over the past several sessions, but ultimately we believe the market is still in the process of pushing higher and a recovery. And so we've said that setbacks, any setbacks that we see should be supported in the 126 area in favor of an eventual push higher towards that next key psychological barrier and a retest of that level at 130 further up. Only back below 124 would compromise this outlook. Kiwi dollar. The New Zealand dollar has been pressured to the downside over the past several weeks since topping out by a 2017 and plus 2-year high up around 75.60, and so the market should continue lower now. That's where the focus is, and any rally should be well capped, ideally in the 71 area ahead of the next downside extension below 68.18, which is the 2017 low going back to May that was matched in the late October. Break below there would open a downside extension exposing 65. SPX 500. The S&P 500 is showing signs of stalling out, but the market would need to see a close back below 25.44 to suggest that we're seeing some form of a shift in the short-term structure. It would take the pressure off the downside, at the top side at a minimum. There certainly is risk, medium and longer term, for a much more significant decline, but at a minimum, the market needs to see a break and close back below 25.44. Until then, the market is continuing to focus on fresh record highs, currently in place just shy of 2,600. Gold. So gold looking to turn back up. The market has seen some sharp setbacks over the past several months, but ultimately pretty much being very well supported for higher highs. Most recently, a higher high in 2017 high at 1357 in September. And so the market's looking to push through that high eventually and towards a retest and break of the 2016 peak at 1375, and only back below 1200 here would compromise this outlook for gold.